Hey, welcome to the podcast, everybody. Thank you for joining me here today, and I must admit, it's been a while since I've done one, and I apologize for that. Just been extra busy, so here we are, the green on the screen, and things have changed a little bit from the last podcast, and we'll go through that in just a minute. Let's go through the numbers first. Dow Jones, highlighted in yellow there, up 95 points, gave back some of those gains, which we'll get to in just a second. Transport's up 1%, NASDAQ's up 1%, Treasury rates all the way over 1.6%. Russell 2000 was pretty strong, as you can imagine. Utilities, obviously not as strong, and actually gave up whatever gains they had, which would make sense. Money was coming out of kind of the recession trade today and into kind of the growth on trade or risk on trade. And then, of course, we have the financials up 1.68%. So just kind of a reversal of everything that we've been seeing lately. So today was about hope, right? Hope that Germany would do something. Hope that, and rumors. Hope and rumors. That seems to be the theme. Hope that QE3 will come to fruition tomorrow. We've heard about coordinated efforts to more stimulus. There's rumors of Germany doing something. And so you combine all these things, and the stock market obviously being oversold and gets a run. And regardless of how bad markets are or how horrible the fundamental news is, you're going to get rallies even in bear markets. And I got to tell you up front here, I think we are on the verge of transforming from a 3-year-old bull market, which started in March of 2009, to a bear market. And we've had 2 major corrections along the way, and technically one last summer was a bear market because it was over a 20% decline. But those have been major summer corrections along the way. And as I've stated before, a typical bull market lasts about 39 months. And here we are, a little past 39 months. But when you combine the technical aspect of what we see, which is a weak demand rally, and that included all of 2012. The rally that we've seen in 2012 from January up until April or so, that was on really the selling going away from last summer. It was like holding a ball underwater. When you let it go, it floats to the top. That's what we saw in the early part of this year, all the way, January all the way through April. That's what we saw. And then any little bit of selling picks up, it goes down, and that's what we're seeing now in combination with. So we got the technicals that are weak, and then you combine that with obviously the economy continuing to slow. And a lot of people got fooled in the first quarter of the year thinking that, well, some of these economic indicators are coming a little better than anticipated, so maybe we've avoided, the slowdown. And we haven't. We haven't avoided the slowdown. So now remember, this is very important. If it is a bull market becoming a bear market, it's a process. It's not a day. It doesn't just happen. It's not March of 2009 where it just turns around one day, and that's how bottoms are formed. Is it's going down, and there's tremendous intensity, multiple 90% down days where everything's down, all the volume's down, and then it's immediately followed by very, very intense up days. The selling exhausts, the demand comes in, and up we go. But tops don't really form that way. They kind of form over a long period of time, where you see sectors that were participating all of a sudden not participating. And we know that's been the case with materials. You can go look at the coal stocks. A lot of those have been just horrible. So it's a process. So far, lots of things have held up okay, and there's lots of stocks that are doing quite well. But let's get to the markets here in the kind of the short run. I had drawn this line a while back, and I had told you that I thought we would see a bounce. And, we got that bounce here, and I'd covered actually my short on this day that I had. I had a small short in the Russell 2000. And when we bounced, I remember doing a podcast saying, I think we were going to come up to this area here, right in here. And we didn't. We turned around, as you can see, and failed. Now, we have gone back to that spot. We've gone back up to what you can see here. The red line is the 100-day moving average, and it reversed today. It couldn't close above it. That doesn't mean that it's necessarily over. We could run up a little higher and perhaps test this, which was, basically the support line, so to speak, could be resistance on the upside. So, I think we're getting close to the end of this little run, simply because we haven't seen the intensity that we would like to see in rallies. Now, you can see I just switched it to the SPY, just so we can see a better indication of volume here. And look, today, 134 million shares on the SPY, far below average. You want to be seeing these big green bars on these up days, and obviously not seeing that right now. What you want to see is, big old green bars. That's what you'd want to see, and we're not getting it right now. So, that's a concern, but it's not just the quantity of volume. I always talk about that. It's the quality of volume, and we're not seeing it right now. We were oversold. There's hopes that, QE3 is coming, and it's a sad commentary that the market goes up because it hopes that there's more stimulus because things are so bad. But that's really what's going on right now. And the fact that it didn't hold today's rally is a little concerning if you're somebody that's heavily in stocks. This is the S&P 500 today in this 5-minute picture, but you can see that we were ramping up and then kind of gave it back. And it wasn't an awful day, but it certainly, you would like to see, if you're somebody that wants, to own stocks and is bullish, you want to see this finish at the highs of the day on very heavy volume, and we just didn't see that. So not a bad day, and certainly, it's broken out from this little area down, in the bottom area here. But I think we're going to run into some headwinds here, and especially depending on what the Fed says, which I've been saying for a while. I thought ultimately they would do some type of quantitative easing. I don't think they will use the terminology. They could be doing another twist program. They could make up something new. But at the end of the day, it's going to be more stimulus. We're in an election year, and the markets may like that. But we're not seeing the demand. It seems to me that there's a lot of money on the sidelines in cash, and I have a lot of money in cash. And I think people are scared to go short because of the fact that they could come in with some big quantitative easing program, and it could boost the markets up. On the other hand, you don't want to go long because the economy stinks, and Europe is still has a big problem on their hand, and the emerging markets are slowing down. So when you put all that together, the market's drifting around aimlessly, and it got oversold, and the people that were short perhaps from May until June covered their shorts, and we're floating up now. And floating is not the way bull markets are made. So I think we're very close to this thing rolling back over again. And I think in the big picture, we need to be getting positioned for potentially moves lower in the next coming months. Now the volatility index, which we're looking at, has been acting kind of weird the last couple days. Yesterday we saw it down quite a bit. It opened at 2247 and got all the way down to 2081. So a big drop yesterday, and that was on mediocre day. And then you come in today, and the stock market is up 100 points on the Dow, and the volatility index is actually up a little bit. So something weird's going on with it, and not really sure. But that's why the volatility index is so tough to trade, because A, there's not many instruments that allow you to trade it effectively, and then B, it's not necessarily an index that lends itself to always being the opposite of the stock market or anything like that. So it can be very tough to trade. And obviously when it spikes up and the rate of change is very fast, then you can sometimes trade it. But in general, it's something that you get these last couple days and it makes it difficult to trade. So I'm not trading the VIX right now, and haven't been for a while. I did get a question today about Southwest Airlines, and obviously Southwest Airlines has been a nice little stock the last couple of months as oil prices have come down. So as that's happened, obviously Southwest Airlines LUV has ramped up. So the question is, okay, well, where does this thing go? And where should I be taking profits, etc. I think as we see the 20-day moving average is going to continue to do this, I think that's going to be your stop. I think it's going up at I wouldn't say a parabolic rate, but certainly when something's moved from down here to $7.82 all the way up to $9.23, that's a big old move on a single-digit stock. So I would say, hey, if this thing starts to roll over and head, and breaks this line, that's your stop. And then, potentially look to get back in, maybe if it hits right here, because you're going to have this moving average coming across, and you're going to have this one crossing back up. So it could come down and then you can be off to the races once again and get down in maybe the 850 range. So I would certainly wouldn't buy Southwest Airlines right now, but I wouldn't be selling it either. Now, I just want to go through a couple of quick charts. I'm not going to spend a lot of time today on these, but basically, we've talked about and probably looked at coal, which is this is the coal ETF, KOL basket of coal stocks, just has been just hammered down. $37 back in February, went all the way down to $23.50, and now you're getting this kind of bounce, and you're getting a bounce like this on a lot of stocks. This is just if you want to play this type of thing, it's a short-term trade. You're looking to sell it at higher prices. But that's it. I don't think picking the bottom in coal, again, given the economy, given what's going on right now with global growth, is the right thing to do. But if you look at what's been working, the XLU utilities, which I've been long for a couple of years, I think. This is at and reached a new high today and reversed again because money's coming out of this and looking to reallocate to a coal, and to those types of companies or those areas that are beaten up so much. But utilities continue to work. I'm not selling it right now, but there's going to be a time where we want to go ahead and lighten up. But right now, the recession trade, excluding today, has been working very well. That would involve the smokes, Altria, which I'm long. You look at Verizon. These high dividend, boring stocks have been going straight up, and so that's where I've been kind of parked. And where I'm not are things like financials. Which again had a very good day today and is bouncing right now. But again, the rollover is here. I mean, we had the 50-day moving average kind of rolled over, so it's at a spot right now where it should start to head back down. We mentioned the coal already. You could look at something like the materials ETF. Again, even if you say, well, I think this thing's going to head up, this is probably as high as you can get, maybe the 36 range. Which from 35, 37, risk reward, okay, well, I think I've got $1 out of this, but this thing's probably going to roll over because it's in a downtrend and the economy is continuing to weaken. So those are things that, those are very short-term trades, but in the bigger picture here, I think there's bigger themes, and the theme is that this market, I think, is continuing to work through this process of becoming a bear market. And I think, you go back to the 2007 time frame, and you had plenty of time to sell. And that was the thing, was a lot of people kept thinking that it was going to go up forever. And all during this time frame here, in 2007, the market was going up, and there was plenty of negative divergences building. And it was a similar situation to today. And I'm not calling for an '08 collapse. I don't know if we'll ever see something like that again, but although I think we should be prepared, given that a lot of the stuff that happened then hasn't been fixed, and you could argue is worse in 2012 than it was in 2007 and 8. But the point is that during those times, there was a lot of things rolling over, a lot of stocks not participating, just not a healthy bull market. And so, but yet the indices went up for a good year. The economy was weakening. Bunch of bad stuff, but the indices were going up. The large caps were kind of leading the way. And then finally when it cracked, obviously it went all the way down from 14,000 down to the 6,000 range on the Dow Jones. And a lot of you listening remember us talking about that back then. And perhaps if you did sell and lightened up at that point, it really did change the course of how your life would go. That was a big deal. It was something that could have changed the way, were you going to continue working for the next 10 years, or were you going to maybe work 2 more years because your retirement went down by 50-60%. And there was a lot of people that happened to. And so the point is that when you start getting those signs, yes, you want to eke out every little gain in the stock market, but you got to think bigger picture here. And I'm just telling you that I'm starting to see some of the same things happening today that I saw back in '07. And again, I don't expect this, scenario to play out, but I do think we could see something where the market could easily fall and have, easily another 20 to 30% correction, even if it's just a correction. That is something that can happen just because of volatility, and we've seen that the last 2 years. If we just simply have a pullback, you're talking about, a decent sized correction you want to participate in. But I think something bigger that we need to be looking at is that the market has run up from 2009 until now, and it's had these volatile summer corrections, but it hasn't really turned into a bear market yet. And I think it may be in the process of doing that, looking at the underpinnings, looking at the economy. So just be prepared for that. Now, if with that said, that doesn't mean that you sell everything today and just park it in cash. I think there are trades that you can make. And I think when we view this market in different time frames, then it frees you up to do different trades. It frees you up to say, I'm going to buy this. I just know in my mind this is a rental. This is something I'm going to probably sell in the next 2 weeks, 2 months, whatever it might be, because, again, this is a process of a bull market becoming a bear market. And look, guys, I hope I'm wrong about this, and I want to stay positioned to at least benefit from the upswings in the market, but I'm not going to mortgage the farm and put everything I have in stocks, because we know we're not at the 2009 level where it had already sold off, right? We know we're already at the stock market has already doubled from the bottom. So, I mean, do you think it's going to double again and go to 24,000? Again, given the conditions that we're under here? No. It's highly possible, though, that we make our way through the rest of the year because there's so much stimulus and it's an election year. That could be. And you may say, do you remember back in June, Karl, you were saying that this thing was in the process of becoming a bear market, and here we are, and the market's holding up. If that's the case and the internals are still weak, it just hasn't happened yet. But what I'm hoping is that from a bullish standpoint and from somebody who's hopes that things get better in our country and our world, I hope that volume comes back in and there's some real solutions to get this global economy back on track. But I don't see it. I don't see them doing anything that's going to help this. So right now it's just throwing good money after bad, or in this case probably bad money or borrowed money after bad, and that may cause the stock market to lift a little bit, but it's not fixing the problem. I don't think this thing can run on fumes that long. So it's something that we got to continue to watch and participate in, but just have some exit strategies in the overall portfolio. And again, for me, I'm keeping my beta pretty low overall, and that beta, as I said before, includes income production, that includes cash, that includes some recession type stocks that we just went through. Those how you keep your beta low. I'm not short anything right now, but I am looking to add shorts because, again, if we get into a scenario where the market does start to fall, and again, not that it's going to have an 08 type fall, but if it does start to roll over and head down, you need to view this as a capital gains portfolio. How do I make money? Well, shorting stocks is how you make money in a down market. And so even though I'm not short right now, there's going to be a time where I probably will be. And it's not going to be an insignificant portion. But right now, let's let this thing play out. If they continue to add, do quantitative easing 3, the stock market may love that. And we want to participate and make money. So let's just stay opportunistic, not be a perma bear, not be a perma bull. Just be opportunistic and take profits when they're there. And when things are a good deal, take advantage of them because there's stocks that are going on their own accord. But I think the people that are, again, nestled in a bunch of mutual funds spread out, I think they're going to have a really tough time over the next couple of years. So, and again, we take this podcast day by day, and I hope that things change. I'm just telling you what I see. As far as I can see out the front windshield, I see trouble ahead, and hopefully that will change. But right now, I don't see that. So, I'm still playing it a little cautious right now. All right, thank you for joining me. Appreciate it. Sorry it's been so long. I promise I'll do them a little more frequently. KarlEggers.com, EggersCapital.com, Twitter.com/Karl Eggers, Google+. Take care, everybody.